Welcome back to the Neuro Finance Masterclass. Tomorrow is day 100, but today we conquer the peak of fundamental analysis.
That's right. It is a huge day. We've already looked at earnings and we've analyzed debts, but now it's time to bring it all together into one powerful lens. Today's theme is ROE and DuPont Analysis, the efficiency X-ray. Seriously, this explainer is going to completely alter how you view corporate performance.
Let's jump right into Section 1, the ultimate shareholder metric, return on equity.
So when analyzing a business, the amateur usually just looks at the total net profit, right? They see this massive billion-dollar bottom line and they instantly get excited. They just assume a huge profit number automatically equals a phenomenal investment. But you, the true architect, you look deeper. The architect knows that absolute numbers can be incredibly deceiving if you don't actually know how much capital it took to generate them.
Exactly. Which brings us to literally the core question every single investor must ask before deploying even 1 cent, and that is, how hard is my money working inside this business? Like, are the executives just being lazy with your capital? Are they sitting on a massive pile of cash doing absolutely nothing? Or are they maximizing every single penny to build compounding wealth? We are looking for the definitive measure of corporate efficiency. We're looking for return on equity, or as we call it in Turkish, o sermaye karlılığı.
Moving on to Section 2, the ROE baseline, establishing the core. Well, before we can use any of our advanced X-ray tools, we really have to understand our foundational metric. Return on equity, or ROE, is calculated by taking a company's net income and simply dividing it by its shareholders' equity.
Right, and to translate that mathematical formula into something real, this tells you exactly how many cents of profit a company generates for every single dollar investors have actually put into the business. Think about it. If you hand a CEO $1 of your hard-earned money, ROE measures exactly what they hand you back at the end of the year. It's essentially the ultimate scorecard for management's capital allocation skills.
Let's actually put a real number to it. Say you look at a balance sheet and see an ROE of 20%. Now, that looks like an absolute dream scenario on paper. It literally means the corporate machine is beautifully compounding shareholder money at a 20% annual rate. And honestly, that is exactly what we want to see as elite investors, right? On the surface, a 20% return represents a total wealth-building juggernaut. But as any seasoned architect knows, the surface rarely tells the whole story. In fact, it sets the perfect trap for the amateur investor who just stops their analysis right here.
So, we're forced to ask a really tough question. Is the growth real, or is it a dangerous trap?
Because guys, there is a deadly catch here. A company can completely manipulate and artificially inflate its ROE. How? By taking on massive toxic debt. A company with a failing core business can actually still show a 20% ROE simply because they borrowed a mountain of cash to artificially shrink their equity base. To uncover the real truth, to strip away all that financial engineering and protect our capital, we need a much deeper tool.
Which brings us to Section 3, the DuPont dissection, the efficiency X-ray. Enter the DuPont Analysis. Created by the DuPont Corporation way back in the 1920s, this incredibly elegant formula acts as our financial X-ray. It takes that standard, easily manipulated ROE metric and just rips it apart to show you exactly what is going on under the hood of the corporate machine.
It's so brilliant. It breaks ROE down into 3 distinct, measurable corporate engines. First up, we have the net profit margin, or in Turkish, karlılık. Second, we have asset turnover, or vermendilik. And third, the equity multiplier, known as kaldıraç. When you multiply these 3 specific engines together, they create your final ROE number. So let's inspect each engine to see exactly how they drive performance.
Okay, engine 1 is the net profit margin, karlılık. Mathematically, this is simply net profit divided by revenue.
But in the real world,
This measures pure pricing power and operational profitability. It tells us exactly how much pure profit the company squeezes out of every single dollar of sales after paying off all its expenses.
So, if a company has a high margin, it means they have a highly profitable core business model. They've got a product or service people are actually willing to pay a premium for, and they aren't just bleeding cash on overhead.
Next up, we move to Engine 2, asset turnover, or verimlilik. This is revenue divided by total assets.
And this engine is all about speed, right? It's capital velocity. It brilliantly illustrates how efficiently a company uses its factories, its equipment, and its resources to generate those sales. Ask yourself, how fast does the inventory actually move? Are they sitting on dead stock in a warehouse just gathering dust, or are they turning their assets into cash with incredible speed? You absolutely want a business that spins its assets rapidly.
And finally, engine 3, the equity multiplier, or kaldrach. That's total assets divided by shareholders' equity. Listen closely, because this is the danger zone.
Absolutely. This lever reveals exactly how much debt the company is using to fund its assets. This is where dangerous, artificial debt hides in the shadows to just pump up that ROE metric. When a company fails at generating real profit margins and fails at moving its inventory efficiently, what do? They'll often crank up this debt multiplier to artificially boost their final ROE number, completely tricking amateur investors into thinking the business is thriving.
Let's put this into practice. Section 4. Catching the imposters, spotting the real ROE.
Now it's really time to elevate your Neuro Finance fitness. I want you to imagine two different companies, Company A and Company B. On the surface, they both have an identical, beautiful ROE of 25%. Now, without our DuPont X-ray, the amateur thinks both of these companies are perfectly equal. But the architect sees the absolute truth. Company A achieves its 25% ROE because it has an incredible net profit margin and spins its inventory rapidly. It relies purely on engines 1 and 2. It is a healthy, highly efficient compounding fortress. But then you run the X-ray on Company B, and honestly, the reality is horrifying. Company B has terrible, razor-thin margins and slow, bloated inventory. The only reason it hit that 25% mark is because it took on astronomical, high-risk debt through a massive equity multiplier. Company B isn't a fortress. It is an over-leveraged ticking time bomb, just waiting for the slightest economic downturn to absolutely wipe out its equity holders.
Section 5. The efficiency audit. Analyze your portfolio. Which brings us directly to your daily cognitive task. It is time to apply this highly intellectual masterclass directly to your own portfolio by performing a strict efficiency audit. Okay, step 1. Select the top stock in your portfolio on your financial screener. Step 2. Find its total ROE.
And step 3. Use the DuPont method to really dissect the source of its performance. Break down its net profit margin, its asset turnover, and its leverage ratio. Remember those critical metrics? Karlelik, Vermiliki, and kaldrach. You must master this method and audit the engine of every single company you own, because if you understand exactly how they generate their returns, you will absolutely rule the market cycle.
I want to leave you with this final, truly empowering thought. As you analyze the businesses you own tonight, ask yourself this: is your capital being multiplied through pure operational genius, or is the company hiding behind dangerous leverage? Perform the audit, uncover the truth, and we will see you tomorrow for the legendary Day 100.
Can't wait. See you on Day 100.